Welcome to the Deep Dive. We're the show that takes complex stuff and, well, boils it down into clear insights and hopefully some surprising facts just for you.
Hmm.
Today, we're tackling a sector that's absolutely crucial, but maybe doesn't get the spotlight it deserves: Indian trucking. It's huge, incredibly complex.
Absolutely massive.
Yeah, picture millions of trucks moving goods across these vast distances every single day. But, and this is the key thing, it's still grappling with some really significant systemic inefficiencies.
It really is. It's like this incredibly intricate system where, a huge chunk of it is just waiting around, not really being productive.
Exactly.
And that whole logistical puzzle, that's precisely why we're taking this deep dive into Zinka Logistics Solutions Ltd. Most people know them as BlackBuck.
Right, BlackBuck.
Yeah, and they're really out there on the front lines trying to bring some, well, order and efficiency to what's traditionally been a very unorganized market.
So we've got their latest earnings call, Q1 Fiscal 26, and some related financials that you, our listener, kindly shared with us.
That's right.
And our mission today, it's pretty clear. Unpack BlackBuck's latest performance, figure out what's really driving their strategy, and, understand how they plan to actually transform this vital industry.
What makes a company like this tick, basically?
Yeah, what makes a logistics tech company tick? Let's get into it.
Okay, so stepping back, the Indian trucking landscape.
Yeah.
It's just immense. You're talking, what, 3.5 million truck owners?
3.5 million. Yeah.
Operating about 12.5 million trucks. It's a huge fleet.
Wow.
And the industry itself, we're looking at somewhere between $170 to $175 billion a year.
It's a huge number.
And it's growing consistently, 8-9% CAGR. But here's a really interesting stat. About 75% of all those trucks, they're owned by small operators.
Small guys, like fewer than 5 trucks.
Exactly. Fewer than 5 trucks per owner. So incredibly fragmented.
Right, and that fragmentation, you'd imagine, just naturally breeds inefficiency, doesn't it? What are the main problems BlackBuck's trying to solve here?
Precisely. The core issues are pretty stark. First, trucks spend way too much time idle, just sitting, not learning.
Dead time.
Dead time. Then you've got empty runs. Trucks often have to travel, sometimes long distances, completely empty just to pick up their next load.
Which costs fuel, time.
Everything.
Yeah.
And it all adds up to really low billable days. On average, a truck is only actually generating revenue for about 17, maybe 18 days a month.
Only half the month, roughly.
Yeah, roughly half. The other 12 days, they're either unloaded, waiting to be loaded, or actively searching for that next job. Just, downtime.
So it sounds like a sector just crying out for some kind of optimization. BlackBuck must see this as a massive opportunity.
Oh, absolutely. Their whole conviction is built on this. They actually said something like, the only question is really about when would this change, but not really whether will this change.
But they see it as inevitable.
Completely inevitable. They believe these inefficiencies just can't last forever, especially with technology.
And their approach isn't just about the logistics, the moving of goods, but it's also about empowering the truckers themselves.
That's a key part of it. They've spent, the last 5 to 8 years really focusing on solving problems for the truck operators, building tech tools to help them manage their business, maybe even grow it.
Okay, empowering the base. Makes sense. So that's the context. How are they actually doing it? What's the strategy, the blueprint?
Right. So they talk about this 3-vector model. Basically, 3 core pillars holding up their strategy.
Okay.
Pillar 1, a continuous offerings pipeline. They're not just selling one thing. They're constantly innovating, building new services.
Like what sort of things?
Things like vehicle finance, GPS vehicle tracking, solutions for toll payments, their own brokerage service, even advanced stuff like fuel sensors, digital payments, managing fleet documents, a whole suite.
So a real toolkit for the operator. Okay, what's Pillar 2?
Pillar 2 is the BlackBuck platform. That's their mobile app. It's the main digital hub where customers access all these services.
And you mentioned engagement is high?
Yeah, it's surprisingly high. Users are spending, on average, about 43.8 minutes a day on the app.
43 minutes. That's a lot for a business app.
It is. And they have nearly 784,000 customers transacting on it every month. It shows it's sticky. People are really using it.
That stickiness is crucial, especially with such a fragmented user base. Okay, and the third pillar?
The third one's interesting. It's their low-cost distribution and servicing engine. This isn't just online. They've built this variable workforce on the ground.
On the ground? How extensive?
Very. They say it's spread across almost every significant trucking village. Over 10,000 physical touch points. They have a presence in more than 80% of India's districts. It's a serious physical network backing the tech.
Wow, so blending digital with a really deep physical reach. And you mentioned they'd invested heavily in the platform and this distribution network over the last, what, year and a half, 2 years?
Yeah, about 18 to 24 months ago, they really put the big investment into those first two pillars.
So what does that mean strategically now? Sounds like a key advantage.
It's a huge advantage. It means the kind of foundational work, the tech platform, the physical network, it's largely done.
Right.
So now when they want to launch a new offering, maybe a new financial product or whatever, they can just plug it into the existing platform, use the existing distribution network.
At minimal extra cost.
Almost zero incremental cost, effectively.
Yeah.
They've built the infrastructure. Adding new services becomes incredibly efficient. It lets them scale up new ideas really fast without costs exploding.
That really spells out operating leverage, doesn't it? How does that feed into how they actually deliver revenue?
It creates this nice cycle. New innovations get launched onto the platform. They're pushed out through that scalable, variable workforce on the ground.
And that variable workforce cost is key, right?
Right.
Especially with seasonality.
Exactly. Because a chunk of their costs are variable. When things slow down seasonally, like in Q1 or Q2 for trucking, their expenses can actually shrink automatically. It gives them a kind of built-in resilience.
Speaking of performance, let's get into those Q1 FY26 numbers. The quarter ending June 30th, 2025. What's the headline story?
Very strong, really strong quarter. Total income was 159.56 crore,
Which is roughly
about 19 million US, and that's up over 62% year on year.
significant jump.
Huge jump. Revenue from operations, 143.61 crore, up about 56% year on year. And crucially, they posted a profit after tax, P8, of 33.70 crore.
So profitable. And what about cash flow? That's always key.
Very healthy. Operating cash flow is around 63 crore. A big chunk of that comes from collecting subscription revenues up front, which really helps their cash position.
Okay, strong top-line growth, profitable generating cash. Where's the growth coming from specifically? Can we break it down by segment?
Yeah, definitely. So their core businesses, that's mainly payments and telematics, brought in 120.26 crore.
Okay.
That's up about 40.6% year on year. So solid growth there. This includes things like basic GPS, but also these AI's mandated GPS devices.
Those are the government-required ones.
Right, required in more states now, about 7 or 8, up from 4 or 5 a couple of years back. And also their newer fuel sensor product that's apparently growing quite strongly.
So it's not just more payments, it's people buying these higher-value telematics services too.
Exactly. The higher uptake of those value-added services is pushing the growth rate beyond just the payment volume increase.
Got it. And what about the other segment, the growth businesses? You mentioned superloads earlier.
Yeah, this segment really took off. It hit 23.35 crore. Now, that might sound smaller than the core, but the growth rate is huge. 251.5% year on year.
Wow, like 3 or 4 times bigger than last year.
Exactly. It was only 6.64 crore last year. And Superloads is the main engine here. It's shifted from being just like a classifieds board to a proper transaction marketplace.
Okay, and they introduced this new metric, net revenues. What's that about? How does it differ from the standard revenue?
Right. Net revenues came in at 131.85 crore, up 43% year on year. Basically, what they're doing here is, for the Superloads business, instead of counting the entire transaction value as revenue, they're excluding that gross amount and only adding its gross margin to the net revenue figure.
Ah, so it reflects the actual profit contribution of superloads more directly.
Precisely. They say it enhances reporting quality, gives a clearer view of the underlying profitability they're actually retaining from that marketplace business.
Makes sense. Okay, let's talk profitability itself. Adjusted EBITDA, how did that look?
Looked very good. 47.21 crore. That's almost a 4-fold increase compared to last year's 12.10 crore, a 290% jump.
Huge increase. And as a percentage of those net revenues,
It represents 35.8% of net revenues, which is way up from 13.1% in Q1 last year. And they stress this includes the costs of new experiments, investments, so it's a solid measure of core profitability.
that really is a dramatic turnaround. If you think back, weren't they loss-making not too long ago?
Oh yeah, over just the last 2 years, they've managed about 2.5 times revenue growth, but alongside that, a massive 53 percentage point swing in profitability. They went from a negative 18% adjusted EBITDA margin in Q1 FY24 to this positive 35% now.
That's huge. It speaks volumes about the model finally clicking.
It really does. It shows the operating model is working and they're becoming genuinely cash generative.
You mentioned operating leverage earlier. This turnaround must be a prime example of that, right? Why is it so significant?
This is really BlackBuck's superpower, you could say.
Yeah.
They consistently deliver over 70% operating leverage. Sometimes much higher, like 88% year-on-year this quarter.
Meaning for every extra rupee of revenue, 88 pays is flowing through to adjusted EBITDA.
Roughly, yeah. It's incredibly efficient. And the reasons are pretty clear. Almost 90% of the revenue is recurring subscriptions, platform fees, commissions.
Stable income.
Very stable. They have incredibly high gross margins, around 93% contribution margin. After direct costs, almost all the revenue goes to covering fixed costs and profit.
Wow, 93%.
Yeah. Plus, it's asset light. They don't own trucks, they don't own warehouses, no big capital investments tying up cash.
So recurring revenue, high margins, low assets.
That combination means profits just grow much, much faster than revenue. It puts them on a really steep profitability curve.
Okay, super efficient model. But what about taxes? How much of that profit actually ends up as cash in the bank?
Good question. The actual cash tax they paid out in the quarter was pretty small, around 3.8 crore, and that was mostly on income from their treasury investments, not the main operations.
So the bigger tax number in the P&L is deferred tax.
Exactly. That relates more to accounting profit and using up losses from previous years. It doesn't hit their cash balance right now. So their true cash profit is actually higher than the PAT figure suggests, probably around 42 crore. And remember, cash from operations was even higher, around 60 crore.
So the underlying cash generation is even stronger than the headline profit number indicates.
Definitely. Their balance sheet is getting stronger.
Okay, let's switch to the operational side. Are they just adding customers or are they getting existing customers more deeply engaged?
They seem to be doing both. The average number of monthly transacting truck operators grew almost 14% year-on-year, hitting nearly 784,000.
Okay.
But maybe more importantly, the number of power users. These are the operators using 2 or more services each month that grew much faster, over 24% year-on-year, reaching about 386,000.
So nearly half their active users are using multiple services.
Yeah, roughly. That suggests good cross-selling, strong adoption, and likely lower churn among those highly engaged users. They're getting embedded.
And the app usage still climbing.
Yep. Daily time spent on the app nudged up again, about 5.5% year-on-year to that 43.8 minutes mark. And the total value of payments processed, the gross transaction value, or GTV, was up nearly 28% year-on-year to over 6,800 crore.
Okay, solid operational metrics backing the financials. You mentioned Q1 and Q2 are seasonally slower for trucking. How much does that impact things, and does that variable cost structure really help them ride it out?
Yeah, the seasonality is noticeable. Q1, Q2 generally see fewer new operators signing up, maybe slightly less freight movement overall. But that variable cost structure really kicks in here.
Right.
Particularly their sales acquisition costs, which are a big chunk and highly variable. Those can automatically scale down during slower periods, so even if the market dips a bit, their cost base adjusts, allowing them to maintain profitability and keep compounding that recurring revenue. They expect things to pick up pace again in Q3 and Q4, which are typically busier seasons.
Right, got it. Okay, let's dive into some of the newer things, especially this superloads marketplace. It sounds potentially huge. Is it really a game changer?
It definitely has that potential. They themselves describe it as being in a nascent very creation zone right now.
Meaning early days.
Very early days. They're still figuring out the exact playbook, refining how it works best. They're active in about 4 hubs, really pushing hard to scale in 2 cities specifically.
Yeah.
But they expect exponential growth from it in the next, say, 3-4 quarters.
And the market it's targeting, how big is that slice of the pie?
It's a massive slice. Superloads is aimed at the $120 billion segment of India's total $200 billion freight market. Specifically, the part that deals with full truckloads, loads found on the open market.
The spot market, basically.
Yeah, the spot market. And traditionally, that's been handled by literally hundreds of thousands, maybe 250,000 offline brokers. BlackBuck wants to bring all that online.
Okay, huge ambition. But what's their edge? Why do they think they can succeed where it's been so hard before, especially getting the trucks, the supply side?
This is where their existing business gives them a massive leg up. Because of their payments and telematics services, they already have relationships with a huge chunk of the long-distance truckers in India.
Ah, the ones they need for superloads.
Exactly. They estimate they have somewhere between 15% and 70% market share of these operators in different regions. So the supply side is already kind of pre-incubated, activated on their platform.
They don't need to spend a fortune acquiring truckers for this new marketplace.
Minimal cost, really, compared to starting from scratch. It's a huge advantage.
So if they decide to launch superloads in a new city or region, how fast can they do it?
They reckon pretty quickly. around 15 to 20 days to get a new market operational. It involves setting up a small local branch, hiring some fulfillment staff, and then activating the shippers, the people with the loads, in that area.
Okay, sounds efficient. What about the money side? How do they make money on superloads? And what are the risks, like getting paid?
It's designed to be low risk. They operate on a cash and carry model. They collect about 90% of the payment up front from the shipper.
Before the load even moves?
Mostly, yeah. Which means their risk of bad debt or chasing payments is close to zero, as they put it. Their revenue, the take rate, is simply the difference between what the shipper pays them and what they pay the trucker who carries the load.
Okay, clean model. Now, flip it around. Why would a shipper use superloads instead of their usual offline broker? What's the value proposition for them?
Several key things. One, a high fulfillment index. Because they have so many trucks already on the platform, they're more likely to find a truck quickly when a shipper needs one.
Reliability.
Reliability. Two, wide lane coverage. Unlike some offline brokers who specialize, BlackBuck can handle most regional routes. Three, live tracking. Shippers can actually see where their goods are in real time.
Transparency.
Transparency. Four, professional handling. They offer more predictability, better systems for dealing with problems compared to fragmented offline players. And five, quality trucks. Because they know the truckers through their other services, they have KYC data, performance history, they can offer a more vetted supply.
Makes sense. So who do they see as the main competition then? Are there other big tech players trying to do the same thing?
Interestingly, they say their biggest competition is just the market itself. The sheer difficulty of cracking this deeply entrenched offline way of doing things, especially building that reliable supply base.
So the inertia of the old system.
Exactly. They feel that formal, direct competitors are still too nascent, basically too small or early stage to be a major factor right now. And the overall opportunity is just so massive. They're also focusing specifically on SMBs and 3PL transporters, not necessarily the giant enterprise shippers, which maybe avoids some head-to-head battles for now.
And what about their older classifieds business? Does superloads make that redundant?
Apparently not. They say the classifieds monetization is still going strong. In fact, they offer a small, like 1% rebate on superloads for people who subscribe to the classified service. So it seems more synergistic, different tools for potentially different needs or users.
Okay. They also mentioned renewing an insurance license. Are they getting into the insurance business now?
No, not really getting into it as a primary business. It was just a renewal of a license they already had. The plan isn't to start aggressively selling insurance policies. It's more about improving the margins on the insurance they already facilitate as an add-on.
Ah, so if someone gets insurance via their platform anyway?
Exactly. By processing it through their own corporate agency license, they can potentially capture a slightly better margin on that existing transaction. They call it a small plug-in on the app, not a major new business line.
Got it. And the PPI license, the prepaid payment instrument, that sounds more significant. What's the goal there?
They got full approval for that on July 2nd. The main goal, they say, is enhancing the customer experience, making payments smoother within the app, and enabling, again, a little bit of margin expansion.
So potentially cutting out some intermediary costs.
Potentially, yeah. They'll still work with banks, but having their own PPI license gives them more flexibility. Longer term, it might let them create more innovative payment products, especially around tolling, which is a big expense for truckers.
Okay. What about that chunk of money, about 200 crore, they raised in the IPO specifically for sales and marketing? How's that being used?
They said it's being deployed pretty much exactly as planned in the IPO document spread evenly over 3 years. And it's mainly going towards those on-ground deployments.
The physical network, hiring people.
Yeah, leveraging that physical distribution network to directly acquire customers out in the field. Direct acquisition efforts.
Makes sense. And lastly, employee costs. With all this growth, did those jump up significantly in Q1?
Well, Q1 and Q2 actually show some of those variability efficiencies we talked about. Because a lot of their sales acquisition cost is variable, it adjusts down slightly in these seasonally slower quarters.
Ah, so Q1 might look artificially low on that front.
A little bit, yeah. Their core salaries are growing normally with inflation, and they fully expect overall employee costs to rise in Q3 and Q4 as activity picks up. So the Q1 number reflects seasonal efficiency, not some major cutback in core staffing.
Okay, this has been incredibly clarifying. So pulling it all together, BlackBuck had a really impressive Q1 FY26. Strong revenue growth, yes, but more importantly, that huge swing to profitability and the powerful operating leverage kicking in.
Definitely. It feels like those big strategic bets they made a couple of years ago on the platform and the distribution network are really starting to pay off now.
Yeah, allowing them to launch things like superloads without massive new costs. That asset-light, high-margin model seems to be proving itself out.
And what's really striking is how they're using tech not just to optimize, but to tackle really fundamental inefficiencies in this enormous traditional industry. It's about empowering those thousands of small truck operators, making the whole sector more organized, more efficient for everyone involved in the supply chain in India.
It's a fascinating case study in tech disruption.
It really is.
So it leaves you wondering, doesn't it? As tech seeps into every area, what other seemingly unsexy or historically inefficient industries out there are just waiting for this kind of transformation?
Yeah. And what kind of unexpected partnerships might we see? Maybe tech firms teaming up with very traditional players in new ways.
And what does BlackBuck's journey really tell us about the kind of long-term thinking, the patience maybe, that's needed to truly disrupt a market that's so deeply set in its ways?
Yeah.
Something for you to think about.